It is my pleasure to welcome you to the National Bank of Fujairah's Knowledge Series. I am Ahmed Al-Meheri. It is my honor to serve you as your host for today's gathering. This event marks a significant milestone in National Bank of Fujairah's ongoing commitment to fostering knowledge exchange, set to unfold over the course of 2024. In collaboration with London Stock Exchange Group, we have curated today's event under the theme, Expanding Investment Horizons, dedicated to sharing valuable insights and strategies aimed at enhancing investment prospects and securing returns. We encourage you to also engage with our distinguished speakers and forge meaningful connections with fellow professionals in the industry. Before we proceed further, I would also like to mention that National Bank of Fujairah has recently achieved 8 remarkable rewards for its service offerings and efficiency. These awards include recognitions such as the Best Commercial Bank, Best Islamic Window, Best Trade Finance, and Best Cloud Implementation, received from organizations such as MIA Finance Awards, International Finance Awards, and Euro Money Awards 2024. Without further ado, may I now invite Dr. Hamad Al-Zahmi, Head of Segments, Retail Banking, National Bank of Fujairah, to share his thoughts with us. Dr. Hamad.
Assalamu alaikum. Good morning, everyone. Thank you all for taking time to be with us today. We value your relationship that based on trust and mutual understanding and collaboration. In a world of ever-evolving markets and opportunities, it's crucial to expand our investment horizons. Today, we've gathered a lineup of a distinguished speaker who will share their valuable insight and strategies aimed at maximizing returns. Through this collaboration with the London Stock Exchange Group, we aim to provide you with the tools and knowledge necessary to navigate the investment landscape. Get ready for exciting information and knowledgeable moments. Once again, thank you so much for being here today. And now, without any more delay, I'm thrilled to hand over this stage to our MC, Mr. Ahmed. Thank you.
Thank you, Dr. Hamad. Let's start with our very first presentation of the day to provide an update on the economic outlook and identifying investment trends and opportunities. Our speaker for this session is Ritesh Nayak, Product and Market Specialist, London Stock Exchange Group. Ritesh is a product and market specialist supporting London Stock Exchange Group buy-side clients across Middle East and Africa. In his 15-year career, he has worked with clients across UK, Asia Pacific, South Asia, and Middle East, mainly focusing on the investment areas across different assets classes through different macroeconomic situations. Ritesh Nayak holds a master's degree in finance from the London School of Business and Finance. Mr. Ritesh, if you can join us on stage, please.
This is working. Good morning, everyone. Great to see this considerable audience present here today. I thank you for making the time, and I thank NBF for giving me this opportunity to present my views about the global markets as they stand today. I thank you for giving the wonderful introduction. Well, throughout my 15 years that I have been in the markets, there have been few moments where there are unparalleled uncertainties and immense opportunities to generate wealth and look for value. Though given my role today, I would refrain from sharing any calls, but I would leave that part for the panel to discuss later, and obviously for our esteemed NBF colleagues to guide you on later. My aim for the next 30 minutes is to present to you my view of the global economy and interesting topics that we can pay attention to. I would try to keep it brief, broad, and will do my best to cover as many topics as possible, and hope you find it interesting. So what will be covered today? In the following slides, we will cover an outlook of the macro view, global growth potential, inflation worries, followed by what do institutional fund managers around the world say or think right now, and some important regional updates. We'll follow that with some relative performance charts of different asset classes to see what has been working and what hasn't, and some interesting charts that I've really thought that you would like to have a look at relating to emerging markets. After that, we will take a quick look at the UAE real estate market and the IPOs in the region. And finally, I would like to share a few points on what to watch for when we are allocating assets. So let's start with the global economic outlook. Despite the highest Fed funds rates since 2001, global growth has remained relatively resilient, coming in at around 2.7% last year, which is around the long run average. As has been the case since COVID, post-COVID period, global resilience pretty much means US, right? Where there was a big expectation of the economy to slow down, but instead it sped up to around 4% by the second half of last year. Now, in the whole discussion around the US recession, the interest rates, etc., there is one key market which not a lot of people are still talking about, which is China. It's only doom and gloom that people talk about there, but to be honest, it still made a significant contribution when it pivoted from housing more towards energy transition. A fact to remember for everybody is that China's share of global GDP growth has gone from 3% in 2000 to 17% last year, which simply means that even if nowadays everyone talks about China's single-digit growth, a 5% growth today means as good as a 9.3% growth in 2010. So it is still quite significant. In contrast, as expected, monetary tightening across the rest of G7 it has had the expected effect, falling modestly in H2 of last year. Germany and UK fell into technical recession. Japan, Canada, France, Italy stagnated. Even Australia, which has generally weathered a lot of these scenarios, stalled. But the downturn remains mild, in part because of the support from the US demand, US growth. Now, taking a cue from here on, just to go a little bit deeper, if we look at the PMI numbers. For those who are unaware, Purchasing Managers Index gives us a decent signal about the strength of the expansionary forces in the economy. Resilience has continued in 2024 with some evidence of underlying acceleration. The manufacturing PMI, global manufacturing PMI, moved to 50.3 in February, second consecutive month of expansion and strongest pace since August 2022. And similarly with services at 52.4 in February is the strongest pace since July 2023. Global industrial production growth has turned positive in year-end terms with again strength from ex-China measure. As was seen in 2023, much of this comes from firmer than anticipated activity in the US, particularly in the real goods consumption part. Activity readings elsewhere have been more subdued. In the Eurozone, manufacturing PMI has been below 50, and in China, even though it looks safe, the strength is mainly coming from manufacturing and exports, which is balancing out the subdued consumption and property investments. Now, what does all of this mean? Is there a potential for soft landing? Now, I'm not the one to give a yes or a no answer on this, but let's look at the facts. While risks of downturn remain and uncertainty is elevated, the balance of probabilities have shifted towards a soft landing. Global growth is expected to be around 2.6% this year, which comes mainly again from the improvement in outlook for the US. Now, if you talk about the US, fiscal policy has been accommodative, the IRA Act, the CHIPS Act. You can also see inventory in single family housing, equipment, investment, etc. being low. Less volatile services sector also has made the recession dynamics more challenging. All of this points to a higher probability of persistent growth and potential soft landing. This was all about the growth part. This always comes again with the risk part, which is the inflation part, right? This is the next big topic. Core inflation is still poised, still expected to slow gradually in the developed world. US core PC inflation has retreated to 2.8. Euro core inflation has rested at 3.1. Despite this, in recent months, there has been some evidence for a re-acceleration. In the US core CPI surprised on the upside for Jan and Feb, resulting in a firming monthly trend. An upswing has shown even greater momentum in the Eurozone. In the near-term trends may continue in a similar fashion, with oil swinging from being a reason for disinflation to actually firming influence. But in the longer run, I suspect gradual disinflation will recommence in the coming months. Now, what does that mean for, at the end of the day, we are looking at the interest rates, right? How that will go, and that will help define where we invest, how we allocate assets. So what does this mean for policy rate expectations? The progress made so far on the fight against inflation by the central banks have given them some room to ease policy in case growth is affected. Nonetheless, I expect them to be patient in the near term and refrain from easing until there is a stronger evidence that inflation is on course to return to target. Even market pricing has broadly moved towards this view. Expectations for Fed easing in 2024 up until recently was expected in July, which has now moved to September. And the market is expecting for the dollar for around a 50 basis point cut this year and a 50 basis point next year, which was as high as 75 till a few weeks ago. And for the ECB, similarly starting June, an expectation of 75 basis point cut till and another 75 basis point next year. This is what the market is pricing in, so it's pretty much in line on that front. A note on the second biggest economy in the world, as I mentioned at the start too, it has its own problem, it is going in its own direction, but it's worthwhile to have a look at it. So top leaders that have set a growth target of 5% for 2024, which is an ambitious one, but I expect them to still meet the target and then probably bring in stimulus to do so. Policymakers probably will be reluctant to miss the target, but at the same time also not over-deliver. So stimulus expectations are to be rolled out around gradually and in a reactive way than in a proactive way like they have done before. This year's GDP target implies that fiscal policy will be expansionary and could be, because of the reactive nature, could be an important driver for quarterly fluctuations in the economic growth. The housing market, which is a big part of the Chinese economy, has been weakening since early 2024. Key development there will be to watch out for whether and when the central government will step in as the buyer or lender of last resort. And while I was making this, actually a day before yesterday, an article came out where there's an expectation that the central government through the local government is going to start purchasing unsold homes. Now it's not yet completely confirmed with official line, but this is what is being discussed. So this was, just to recap, global growth looks like it's going to fare well. Inflation is sticky, but expectations are for it to follow the course to a manageable number, which leads to rate cuts starting Q3. Now let's look at what the global fund managers, the institutional fund managers are thinking or talking about. So this is a survey which is done by Bank of America Merrill Lynch across their institutional clientele, portfolio managers across the world. And there's a bunch of questions that they ask, a long list of it. But I've taken just a few points that could be, that are interesting. The chart you see on the screen is the broadest measure in the survey of sentiment based on cash levels, based on equity allocation, based on economic growth expectations. It is at the most bullish since Jan 2022. Investors turned bullish on the macro for the first time in December 2021, and it has kept going up. While global growth expectations are picking up rapidly, they're still playing catch up with equity prices, and we'll see that in a few charts later. A note to watch out for what I particularly found in that survey was the average cash level of this, the correspondents in this survey fell to 4.2% of their AUM from 4.4%. Now it is not alarming by any means, but historically when this number goes below 4 is when there's a contrarian theory or for a sell signal for equities. 78% of the correspondents say a global recession is unlikely, which is jumped from 65% a month ago and highest since 2022. The next, one of the other questions that I found interesting is, what is the most likely outcome for global economy in the next 12 months? Right? Expectations for an economic boom have spiked to 24%. That statement sounds great, but to be honest, if you look at the whole number, 60% still expect stagflation. It is still down from 92% in September 2022, but it's a number to watch out for. Expectation for higher inflation is still rising, so the higher for longer theme is what the fund managers believe will continue. 76% of these investors expect at least 2 cuts this year, which is quite in line with what is priced in. But there are 8% of them who expect no cuts this year too. Few other charts that are interesting are 38% of the fund managers expect bond yields to be lower in the next 12 months. Net 26% of the fund managers say gold is overvalued at this stage. And specifically coming to the equity part, the hot topics, there are quite a few themes going on with AI and electric vehicles and a lot of things. There was a question about what do you think is the most crowded trade as of today. And the biggest one that took the pie is the Magnificent Seven. We'll also look at a chart later on why they must be thinking that. But then recently, the Japanese markets rising, that has also been a hot topic. But in this survey, 14% are picking that as a topic as being one of the most crowded trades. Now that we've looked at the global economic outlook, just a few pointers on specific regions which matter, which make a big chunk of the global GDP. Looking at the US, recent data have become more supportive of US growth. While the outlook remains uncertain, this shifts the probabilities for the mild recession. Real GDP growth is expected at 2.1% and unemployment to actually trend sideways. Given the increased confidence in around the continued labor market resilience, the market seems to be correctly pricing in the delay in rate cuts. Things to watch out for will be the real services reading and the real wage growth. For China, as mentioned earlier, policymakers have an ambitious target of 5%. But in the past 2 decades, they have missed it only once. So I expect them to still achieve the number. I mean, that's my personal expectation. Looking ahead, policymakers may step up stimulus measures. Housing and fiscal policies will be the key to watch out for. Another thing to watch out for China will be the producer side of the economy, the capex, infrastructure investments, exports. The resilience in the industrial sector has bought policymakers time to deflate the property sector till now. But any slowdown there because of the trade tensions, because of overinvestment, then the policymakers will have to jump in to support the housing markets. For the Eurozone, economy stagnated in 2023. The weak period for the economy doesn't appear to have come to an end just yet. There is near-term weakness, likely led by a contraction in the industrial production. Consumption growth has also been weak in the near term. And recent inflation readings suggest inflation is sticky and it's going to stay that way for a few months. A note on the UK. UK slipped into a technical recession in Q4 of 2023. However, I expect growth to pick up there, mainly because wages are now growing faster than prices, so there is a bit of spending power, and business PMI surveys have returned to expansionary territory. However, it won't be smooth sailing for the economy simply because of the interest rate staying higher for longer, which will weigh on some sectors. Now let's take a breather from the whole global economic view and let's look at what the markets say. So I built some charts looking at the total return performance of different asset classes over a longer period of time. In essence, these charts show the performance of one asset class over the other, and a few notable ones, I've shared them here. In this particular case, you see the performance of equities in different regions over the government bond performance, and equities clearly outperformed the treasuries and are still going stronger. If you look at the fixed income side, investment grade credit outperformed government debt, simply stating it's a risk on environment at this point. And if you compare equities with the high yields, equities still outperformed and continues as a global theme, global energy and materials showing the very strong returns. Fixed income has seen positive total returns, but despite the hawkish central bank rhetoric. Now, while doing this, looking up for these charts and some data, I also found another small thing which could be of interest is the fund flows, the AUM flows of mutual funds and ETFs. I noticed that US mutual funds, actively managed funds, have seen an outflow in equities and inflow in bonds, whereas the ETFs has seen inflows in equities. Now, since equities seem to hold most of the interest, let's look at some valuation metrics for different regions. S&P 500, as expected, is commanding much higher multiples compared to other regions and close to recent highs. This is mainly because of the heavy reliance on the Magnificent Seven stocks in the index and the strength of the US economy. If global growth persists, then some EMs represent, emerging markets represent an opportunity at low forward Ps. On the defensive view, Europe and EMs do present an opportunity, there is value, though the macro outlook we just saw suggests some caution and vigilant stock picking or fund picking. Now, a note on the emerging markets part. There is a growing interest towards it. Fund managers are chasing alpha outside the crowded US space. And I found some interesting charts I would like to share. So the Magnificent Seven stocks, Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta, they represent a large chunk of the outperformance in the US. Since the launch of, if you look at the chart, since the launch of ChatGPT 4 in March 2023, the combined market cap of these stocks as a percentage of the index has been rising and now represents almost 40% of an index made of 500 stocks. And if you compare it to an emerging market index, it's almost around 80%. I looked at also the rotation of funds. So within the EM, if you look at ETFs by Vanguard, for both the EM and the developed world, one over the other, you see the chart is now, has been declined, but then now is moving up again since the start of 2024, clearly indicating that there is interest in the emerging markets. And if you compare it against the 60-day moving average, it is well above that and is trending upwards again. So there is interest in the emerging markets. Just like a few slides ago though, if you compare the earnings growth volatility of different regions and compare it, put it against the forward PE multiples they command, we again see that the markets still favor US over other developed markets and EMs. Though this could also be, the reason could also be China in the EM markets. It's a huge part of the emerging markets basket, and investors are generally wary of investing there currently. Phew. So till now we've looked at the global economy, the risks involved and the performance of different asset classes. In summary, the global markets look steady, though some uncertainties and geopolitical risks are present. Interest rates have made have a good case made for them for a gradual flow downwards over the rest of the year and next. And as for the dominant asset class, equities have been outperforming mainly because of US and the Max 7 play, but EMs do present a cautiously good case. Now let's look at a quick look at some of the hot topics closer to home. Over 2023, Dubai capital values grew the most compared to other global cities, and the rental growth too followed closely by being the fourth highest. With the merger of Nakil and Maidan under Dubai Holdings, developers paying higher rates for plots in existing prime areas and rentals outpacing sales, the above trend seems to have a bit of steam still. Residential sales continue to outshine, with more residents transitioning from rentals to ownership, with prices seeing an increase of 6.1% in Q1 of this year, which is the highest quarterly increase since 2014 June. This trend is further expected to continue through 2024 as total stock continues to decline till 2026 when meaningful inventory additions are expected. If we take a look at Abu Dhabi too seems to follow the trend as demand rises, sale prices increase 2.5%. Though in Abu Dhabi, more inventory is expected to come online a little earlier than in Dubai. The recent abnormally high rainfall may dampen some of the premiums paid for villas over apartments. On balance, villas and townhouses fared far less than apartments for water ingress. Rentals still outpaced the sales growth in Dubai and Abu Dhabi, resulting in higher rental yields. And higher rentals in Dubai are in turn convincing more tenants to become owners, which has resulted in higher demand for ready properties. So this is sort of the trend around it. The other talked about hot topic in the region has been IPOs in the recent years. Anyone who's followed the GCC markets in recent years has seen the number of companies going public steadily rising, which is really good for the financial markets. It develops it further. There have been some interesting ones in recent years which have performed really well, and some that haven't. Though if you look closely to this year, out of the 13 IPOs in GCC, most of them have not fared well as was the expectation. Though some notable exceptions are MBC, Middle East Pharma and Al Mudawat Company. Looking forward, if we track the news actively, we see that there are talks or mandates for 16 more IPOs to come online this year. Etihad Airways and Riyadh Capital would be the ones to watch out, at least for me. Now coming to the final part of my presentation, We went through a lot in the last roughly 20-25 minutes. And at the end, it's interesting to know how to move forward. As mentioned at the start, I won't be giving calls today, but just some observations I had while preparing for today. With economics, the global expansion is resilient compared to what most of the market had anticipated. However, the Goldilocks soft landing has been challenged by the sticky inflation. US clearly leads the pack in both robust growth and sticky inflation. But this goes beyond the US. In Europe, the credit impulse looks to be turning up. With growth strong, the risk is that inflation too will remain hot. A message that was sent out very clearly in the March CPI report, which came the super core accelerating to a hot 8.2%. The acceleration in US inflation raises more questions about spillovers elsewhere. Biggest challenge for ECB. ECB signal for June rate cut is that services inflation is running high this year. Overall, from an economic standpoint, commodities rallied, equities delivered mixed performance, bonds sold off on diminished prospects for monetary easing. If you look at equities specifically, Q1 earnings beats are on paper, but the market might not reward them. What I mean by that is, as is typical, consensus projections have been moving materially lower over the past several months. The activity momentum has firmed up during this quarter with rising global PMIs. This improvement combined with the reduced earnings expectation suggests that there will be a lot of companies coming out with earnings beats. Though this is something the market is already pricing in, so something to be aware of. Growing risk of interest rates remaining higher for longer implies downward pressure on global equities. Until now, at least with the rate cut expectations. Japanese equities, strong absolute performance could stall. Key parts will be to look at value and low volatility factors there. And a question that came up was, is Saudi the next India? Almost, but not quite, right? Saudi and India have some similarities. Young and growing population, strong GDP growth, non-oil in Saudi, big domestic investor base and lots of expensive stocks. But there's also limits to this comparison. The size of the market, 1.4 billion to 33 million people, 18% weightage in MSCI versus the 4% in the MSCI index. So in this theme, the biggest thing to watch out for will be that because of the weights in the MSCI indices, global emerging market investors will continue to focus on India at the expense of Saudi at this stage. Looking at bonds, as we've been talking throughout the presentation, inflation stickiness and the subsequent central bank action will matter the most. In the euro area, ECB is on hold. What we need to watch out for is the signal in June, which currently the market has priced in. In the emerging markets, the domestic growth backdrop remains resilient. What's important to watch out for is the upside surprises to inflation and also the uncertainty around Fed easing. So with this, I would like to close out my presentation. I thank the team at NBF again for giving me this opportunity and to the audience for being patient. I hope that the last 30 minutes, roughly 30 minutes, have been just as interesting for you as it was for me to prepare for it. And I wish you all a great session and a great rest of the day. Thank you.
Welcome back, everyone. We will now move into our panel discussion of the day, and the topic is formulating your investment strategy. I would like to invite Ms. Jane Witherspoon, Bureau Chief, Euronews. Jane has joined Euronews in January 2019. She is regularly featured in some of Euronews' best-known titles, like Target, Business Line, and Taste. Prior to Euronews, she worked at Sky News and was a news reporter for the BBC. During these years, Jane covered significant events such as the US presidential elections, the London Olympics, and the Oscars, to name a few. I would also invite on stage our esteemed panelists, Bilal Abu Diab, co-founder and CEO, Volt, Haytham Abdallah, Unit Head, Investment Solutions, National Bank of Fujairah, and Rabi' Murad, Head of Middle East and Africa, Fidelity International.
Hello, ladies and gentlemen. Thank you so much for that very kind introduction. I am Jane Witherspoon, and it's my absolute pleasure to be back here with National Bank Fujairah again. I very much enjoy being part of these sessions and part of the NBF Knowledge Series. So for this panel, we're going to be talking about maximizing your investment horizon. And I know we have introduced them by name, but I would just like to take this opportunity to give the gentlemen a couple of moments just to introduce themselves a little bit more and tell you about their roles. So over to you, Bilal, first.
Thank you. Is this working? Yeah, it is. Yes. So thanks for having me. So I'm Bilal, co-founder of Vault. We're a digital private wealth management platform. Background is very much in wealth management, helping people reach their investment objectives. And now we're looking to do so digitally. And happy to be here talking about a very important topic. Thank you.
Thank you. Haytham.
Good afternoon, everyone. Haytham Abdallah. I lead the investment solutions unit in National Bank of Fujairah. I think as many of you have engaged with before, and we've had many discussions on how to look after their investments, prepare their investment strategies. And it would be great today to address everyone and speak more about something that I'm really passionate about, which is investments and investment strategy.
Thank you. Rabia.
Hello, good morning. Thank you for having me. My name is Rabi' Murad. I work for Fidelity International. I lead our efforts in the region, Middle East and Africa. Fidelity International is a global investment manager, looking after sort of public and private markets for investors across the world. And I also have some experience on the private wealth side before joining Fidelity 7 years ago. Thank you.
Thank you. So let's get down to business, get the conversation going. If I could please start with you, Haytham, and ask you, what does it take to build a successful investor strategy?
Well, first of all, we have to clarify, there is no one size that fits all. There's no one successful strategy that all of us could, start following today. I would assess the success of an investor strategy based on how does it fit that particular investor. And I would start with your expectations. What do you expect from your investments? What level of return are you expecting? What level of risk and volatility are you comfortable with? Once you start with that and establish that, then it becomes easier to decide how do you want to build. Now, obviously, you want your investment to make you happy in the good days, and it generates reasonably decent returns on when the market is up. But at the same time, we understand that when it comes to investments, there are some days the market is up, some days the market is down. There are some good days and bad days. So in the bad days, you don't want your investment to be a big concern that it keeps you up at night. You want to be comfortable. Yes, there could be a level of volatility, there could be some drawdowns, but it should be built to the level that you're the most comfortable with. And that varies across people. So some people are, more aggressive, they can afford to take higher risks. Some people are more conservative and rather, just focus more on the safety of the investment. So it differs from a person to a person. And there are obviously a lot more, and I will, give the chance to my fellow panelists to add their views as well.
I could see Rabia nodding away as some of those points there. You have more to add, I'm pretty sure.
Yeah, I mean, spot on, obviously, very valid points. I think the one thing I'd add and emphasize on is sort of for an individual investor to identify what stage in his or her life he's at. Because risk return, that's very valid, that's very important, but in absolute terms, it's also challenging to build a long-term investment plan based on today's risk return, because as individuals working in various different industries and sectors, your knowledge of financial markets and products is probably less proficient than professionals doing it. Just like my risk tolerance for flying an airplane is different than a pilot whose job it is and who knows and understands the industry. So it's very important to understand where you are in your life cycle and invest accordingly, because today you may identify yourself as a risk-averse person, somebody who wants a low-risk strategy or a moderate-risk strategy. What that means is you'll end up being in less risky asset classes like fixed income or cash or money markets, which is okay. But if you are in your late 20s or your early 30s, you've got a long life ahead of you that you need to invest and save for. So that might not be the best strategy. So I think it's important to complement your risk profile with what stage of your life you're in, and invest accordingly. Because what that will look like is you'll start with a more risky portfolio construction, which will de-risk as you grow into your older years and get closer to retirement. So I think I'll just complement that with a few words. And maybe Bilal, I'll hand it over to you.
It'll be hard to add anything on what has been spoken, but I'll just probably rephrase it in my own words. But yeah, it's spot on, right? What both Haytham and Rabia are saying is it's about personalization, it's about you, it's about what helps you reach your objective. So in more layman terms, it's sitting down and saying, so no one invests just to invest, right? Investing is uncomfortable, so no one wants to deal with discomfort for no reason. We all invest because we have specific objectives. I want to eventually be financially independent. I want to make sure that my daughters go to the best universities. I want to make sure that when they are graduated from universities, they have a nest egg. So the question becomes, okay, when I do save, what am I saving for? Am I going to spend all the saving in a year or in 2 years? When is it likely that I will start using my savings? And now, once you visualize that and you have an actual objective, that's what a time horizon is. And then when we define that objective, then we can talk about risk. What does volatility, as in the movements of the market, really mean to me in the short term versus what does reaching my objectives mean to me? So I think to just paraphrase what has already been said, it's just identifying those objectives and working from there in terms of where should I allocate my money, whether that's cash, equities, bonds, to actually maximize the likelihood of reaching them.
You touched on it there. I mean, in terms of what are the best practices, we've talked about objectives, where you are in life, diversification, education of that. How do investors mitigate risks and maximize returns then, Bilal?
So I think sometimes we use the risk, we use it loosely, as in it's a big word, right? So we have to break it down. And in investing, I think there's two types of risks, right? There's the risk where I wake up and I've lost everything and I just can't make it back. So there's that risk that is I'm going to lose what I've invested. And then there's another risk, which is volatility risk, which is day on, day in, how does that affect? And to use an example, unfortunately, for myself and Rabia, we're Lebanese. So in Lebanon, people used to put money in deposits in Lebanon. And Lebanon was risky. And people used to say, oh, there's no risk because it's deposits. So there's no volatility. But eventually there was a banking crisis there in Lebanon, right? And people lost a lot of money. So first, it's important to identify what are the different types of risk. When it comes to risk of losing with an investment, the way to mitigate that is diversification. How do I own different types of assets? Whether in equities, different sectors, different companies, whether I'm lending to different institutions via bond markets. So that's diversification. And then how to mitigate volatility is very different. How to mitigate volatility is I have to invest in things that don't frequently move up and down in the short period of time. So I think it's important to separate those two risks and you mitigate them differently.
Haitham, I know you had something to add into this one.
Yes, there's many points that we can share and talk about, but I would say continuing on the same conversation, when we talk about risk, it's always associated with return. The cardinal rule of investment is if you're trying to achieve higher returns, you obviously have to take higher risks. However, that doesn't mean that you go all aggressive and lose, because there are certain risks that you can actually reduce and mitigate. As an example, something that Bilal mentioned is the concentration. If you keeping your money all in, or like they say, keeping all your eggs in one basket, how do you avoid that? It's a very simple process. You simply allocate your money across different asset classes. So you would have some money into equities, some money in fixed income and bonds, some money could be kept as cash and deposits. You could have some property investments. That's what we call asset class diversification. You want to take it a step further, then you do what we call geographic diversification. Keep these invest in different regions. So as you've seen in the first presentation, the performance of the US market has been different than the performance of the European market, which is different than the performance of the Japanese market. And if you invest for longer term, you will realize that this also changes. It's not always one market that's always doing really well, but that's also changes. So you want to have investments across all the different markets. And as you start constructing this portfolio, you will significantly reduce the risks that some of the risks that Bilal mentioned, because even if one market is not doing well or one investment is not doing well, for example, in this year, you have your other investments that are keeping you, protected and reducing that volatility. So these are, I would say, some of the really great practices to mitigate some of these risks. And yeah, that's I would say what we call diversification, and that's how you do it in the most efficient and optimal way. One instrument that always comes up when we talk about diversification, especially if you have a limited amount of capital that you want to allocate, is the use of ETFs and mutual funds. With a single, $10,000, you can buy a fund or an ETF that's simply a basket of 500 or more investments all in a single instrument. So you get that benefit of diversification through these different instruments that help you achieve that.
I'm sure Rabia just told me before we came on stage all the places he's lived and worked, and from a very global perspective, I'm sure you can add into that conversation.
No, totally. And I think just to complement what was said, there's also an approach of bucketing your investment objectives and strategies, right? Because there are investment portfolios that should be constructed for the long term and should be held for the long term. And I think one of the easiest ways to be less sensitive to volatility is to not actively trade. If you're invested over the long term, over a business cycle or 2 or 3 business cycles, then automatically you sort of start to flatten that volatility experience. But that's not to say that that's the only strategy you should have, right? Because you can build that long, investment portfolio. You can have a different portfolio for maybe more active trading, and there you manage your expectations in the sense that you're aware that there could be volatility. And you need to always think about what can you stomach, right? But I think a key point to make, and we discuss this a lot with individual investors around staying invested for the long term. And I use the example of the S&P 500. So if you had invested $10,000 in the S&P 500 in 1988, so 35 years ago, and you held it till the end of 2023, okay, so for 35 years, that $10,000 would have grown to become $465,000 approximately, okay? Now, if you missed the 5 best days of the S&P 500 over the 35 years, your return goes down from 465 down to about 230, 245. Okay, so that's how much you lose having missed the 5 best days. If you missed the 10 best days in those 35 years, then that return comes down to 190,000. So you've still made money, but you've lost a lot of that potential alpha, that additional return. So I think the importance of staying invested over the long term and not trying to actively switch out and in of strategies is very rewarding, right? And hence, sort of looking at bucketing your different objectives.
Thank you. Incredible figures, my goodness. Bilal, I want to bring this back to you at the moment, actually. How does the regulator separate treatment of professional and qualified investor from retail investors?
Yeah, so I think it's a global concept as well. So globally, financial regulators would exist to protect the ecosystem and protect individuals from getting bad advice or bad recommendations, etc. And by protecting the ecosystem, what they would want to do is they would want to classify individuals as either professional, either non-professional. Professional is someone who has the knowledge, the experience, and the wealth that would define the fact that they know how to make all these decisions and we don't have to worry about them. So they can do their own due diligence. While someone who's non-professional usually is someone who could be guided or misled or led properly. So those they would classify as non-professional retail, and therefore the regulator would care more about protecting their best interests because they're more vulnerable to advice and to guidance.
For a beginner investor, what is the best way to get started, Haitham? What would you say?
I would say the best or the first step is education. Understand what you're investing in. So I would start with the basics. Equities, fixed income, ETFs, mutual funds. Understand how they are, how they work. Obviously, speak to people around you, speak to your bank, speak to investment professionals. Understand, because these are the building blocks of most of what investment portfolios would be. And stick to them. You know, I see a lot in social media, you know, the newest hot investments in the market, like crypto, VCs, etc. Every day there's something new. But I think over the long run, it's the basics. It's the traditional investments, equity, bonds, real estate. This is what has proven time and time again to be doing well. And I would say for most investors, this is where most of your investment would be. Then you can always have, like Rabi said, different buckets where you can have a bucket where you hold most of your investment, and that's where you're holding it for the long term. You're not taking aggressive risk, and then you can always have a bucket for the more aggressive things, the new themes that come into the market, things that you can afford to take risks on. So understanding and then using the building blocks to construct your portfolio, that's definitely the way to start.
Rabia, you'd agree with all of that? Any additional advice?
I'll add to that. I think because knowledge is absolutely crucial. And that goes back to my point earlier around risk and how you perceive risk, because the less knowledge you have, the more risky something is perceived. So knowledge is essential. But I think to also add to the knowledge bit is also to be aware of our cognitive biases when it comes to investing. And I think this is inherent in all of us as humans, and I think we tend to fall into that trap. And when I talk about, this is common to all of us around behavioral finance and some of these cognitive biases, and it's stuff like anchoring. And what do I mean by anchoring? Some people, they'll see a stock market or a share price reached a certain point, right? And they then anchor on that number. And so they buy, let's say, a stock that's priced at 90 because it's reached an all-time high. And then if that price of the stock goes down, they're still anchoring on that 90, and they still think that it will come back to the 90. But the reality is in investments in markets, things are evolving, right? With a company, with a market, with macro, with geopolitics, with many other factors. And so falling into that trap of anchoring is very dangerous, as is the herd mentality, right? We spoke about the Magnificent Seven and how well they've performed. And as a result, people have seen that performance, people start investing, people start socializing it amongst each other, and then more and more people just start following that herd mentality of investing into what's rising. So, I think it's just good to educate, but also be aware of certain biases and make sure that you don't fall into that trap. And that's where partnerships with, service providers and financial institutions helps. And back to the keynote speech in the beginning, trust. It all comes down to trust and trusting your partner and trusting that your partner is looking after your financial benefits and sort of helping you build, better financial futures.
You mentioned there some of the patterns that you've witnessed. Are there any classic big mistakes that you see people making over and over again?
Yeah, I mean, I always refer back to four. One of them is overconfidence. So investors, beginner investors get overconfident with their ability to invest because they buy a stock, they see the stock price goes up, they buy another one, it might go up as well. All of a sudden they think they can replicate it across the market and they're always going to be successful. Then there's the anchoring that I mentioned, anchoring on a certain price of a stock or a level of a stock exchange. The other is hindsight, looking back and looking at historical performance and expecting it to replicate itself, which never happens. And then lastly is the herd mentality, which is following momentum. And I think Haytham wants to add to that.
Yeah, I would say the two most common mistakes that people make when investing is one, being driven by emotion. And here there are two main emotions that have been significantly studied a lot across financial markets, which is fear and greed. And I would say to a certain extent in the short term, a lot of the market movements that you see are driven by fear and greed. As an example, continuing off what Rabi said, you see the markets moving up. You have what we call FOMO, or fear of missing out. So you want to be in on the action, so you get in. And then, a few weeks later, the market goes down, so you feel afraid and you exit. And usually, because of that fear, the market ends up recovering. So trying to keep emotions away, especially fear and greed, is the way how to address these, I would say, classic mistakes. Being more, I would say, educated and aware of the investment, having a more long-term focus and long-term horizon is the way to go, and that's how your focus should be. One way that I always, think is a good strategy is that, and this is something that I would quote Warren Buffett on, is when, be afraid when people are greedy, and be fearful and be, optimistic and greedy when people are fearful. And usually, if you look at the markets, it's usually the point where people are so afraid of the market is the point that if you bought and just waited for a few months, you would have made really good gains. So having a long-term strategy means that when the markets come down, you're not so concerned. You actually see this as an opportunity to add more to your investment and capture these opportunities that are given to you by the market. The second most common mistake, I would say, is, again, it relates to the first one, is trying to time the market. I've heard this a lot over the last 10 years or so, is that someone will come to me and say, I don't want to invest because I think the market is going to go down in the next month, and I'm going to wait for it to go down. What actually ends up happening is that the markets continue to go up, and they miss out on these, and they miss out on these movements, they miss out on these returns, and then when they finally decide to go in, that's actually when there's a correction in the market. So avoiding these, trying to time the market. If you invest for the long run, historically speaking, there has been different periods and the market goes through different cycles, but if you have more of a long-term focus, you would do really well, and you would navigate through these cycles with ease.
Bilal, I was about to say, we've got 6 very good points there. Have you any more to add to the list?
I just want to add one,
just
actually.
one.
But these are fantastic points, right? And I think it all comes back down to, as well, what we're talking about in terms of bucketing, where Rabia was mentioning. And trading is different than investing. Trading is, I want to take advantage of something that I believe is mispriced. I think something is cheap. I want to buy it because it's going to become more expensive. And you can think about that in real estate, right? In real estate, I'm going to buy this property because I think it's worth much more. But investing is different. Investing is long-term. I'm going to buy this property because it's going to yield me a rental income. Same thing with equity markets, and same thing with bonds. When it comes to biases, the one thing I would really add, which is very essential in today's world more than ever, is confirmation bias. And what confirmation bias is in today's world, when you Google something or you search something or read a specific news that aligns with your worldview, you're more likely to be kept on being fed that same worldview. And that's a risk. So someone who is positive on Bitcoin, for example, is actively being fed positive news and optimistic news about Bitcoin. And that's a very big risk, because now when you go to media, you're getting a media that agrees with your worldview, and that gives you that overconfidence. So what I would say is, whenever you're taking such decisions, it's always good to look at the opposite view. Whenever you're making any decision, it's good to validate with another person's view, whether it's something you trust or not. It's always better to get a second opinion and look at the opposing opinion as well.
And I guess that falls into the education, and you're saying doing your research, knowing where you are.
For sure. And we talk about what's the difference between a professional and non-professional clients. It's knowledge and experience. You gain knowledge through education. You gain experience through starting early. So that's the pathway.
How has the UAE's investor landscape changed over the last few years, Bilal?
It's a good question. I think, first of all, there's much more options than there used to be. I think that's definitely the case. There is much more awareness. There is much more, it's a much more mature ecosystem at the moment than it used to be, with much more actors and participants. And therefore, you can get different views in a more mature product, in a more mature market that has access to different solutions as well.
I think Haitham has more to add on to this, actually.
Yes,
as
definitely,
well.
definitely. I'll talk more about the investor behavior kind of aspect of that question. And I would say, going back 10, 20 years ago, most investors were very, I would say, traditional. They would invest in real estate, their own business, and very rarely where they would invest beyond that. However, today, I'd say definitely investors have gotten way more educated, way more sophisticated. They understand the value of diversification, having money set aside and other than your own business, having money in equities, having money in bonds, having money in real estate. So it's becoming a much more sophisticated landscape of investors. I would say also there's a very noticeable generational difference. Younger investors today, and especially ones that are inheriting the assets from the legacy and their parents, they are looking at way more investment options than before, and I would say they are way more aggressive in their investing. So they are looking into venture capital, private equity, they're investing in startups, they're investing in cryptos, they're investing in global equities. There is less bias towards local investments. They're looking globally. So that's I would say is a very distinctive differentiation and how the landscape have changed over the last 10, 20 years.
Rabia, I think you're
Yeah.
agreeing with a lot of that.
Totally, and so Fidelity's been in the region. We've had an office since 2000, and we've been managing money in the region since the 90s. And over the years, and that growth of assets under management that we've seen, has only become more sophisticated, as the gentleman were referring to. So, and we saw on an individual investor basis, we saw the evolving change from. The region here is very, Haitham mentioned, initially real estate driven. That's what they were used to. That's what they were all exposed to. And as a result of investing in real estate, you're used to getting an income. And then we went through an environment where interest rates were higher in the 2000s, and then they got used to getting income from money, deposits in the banks. And then they experienced the global financial crisis, and they became allergic to equities. And so that income bias then continued, it evolved into fixed income, so again, continuing with the income. But then, since then, we've seen the growth of equity markets and the importance and the role of equity markets in portfolios. We've seen more recently the interest in private markets, so moving away from public markets to illiquid private equity, private credit, so on. And we've seen many players in that industry sort of set up shop in the region. So it's definitely evolved tremendously, and the UAE has set itself as a financial hub.
Haitham, I was going to bring this in to you anyway, but in terms of the UAE's regulations, how are they protecting these investors?
I think it's very important to link regulation with risk, because as investors, you want to take the risk of the market. There are certain risks that you can definitely avoid. As an example, the risk of dealing with a fraudulent entity or an unlicensed entity. And that's very important, and this is what regulation addresses. The last thing you want to do is invest with some unknown company in a country that's really far away, and then even though the investment is good, that company for some reason is no longer there, and you cannot retrieve your money. So as an investor, you can significantly even eliminate this risk or significantly mitigate this risk by investing with licensed, reputable entities that are regulated. See, the regulator is not going to protect you from the market going up or down. That's definitely not the role of the regulator. But what the regulator does is they put in the right legal framework, the right regulation to ensure that the entity you're dealing with is meeting a certain criteria, are meeting certain standards. There is a law that protects you. And as an example, if I have a dispute with a company that I'm dealing with here, I can approach the central bank, I can approach the relevant regulator, I can go to the local courts. There's a way for me to resolve that conflict. However, if I'm putting my money in an investment that's in an unlicensed company in a different country, it's very difficult for me to do that. So I think this is a risk that all of us can really mitigate, and we don't have to put ourselves into by simply investing with licensed entity and regulated entities.
And Bilal, your experience of the regulations here, what are your positives to draw out of that?
I think the regulator here is much more stringent than a lot of places, and that's a good thing. I think a lot of times we look at regulation or the regulator as this entity, and it's not a good, but regulation is a good thing. Regulation is there to protect the ecosystem. The more stringent the regulator is, the more firms have to be well-functioning, have the right processes, etc. And if you compare UAE to the majority of the world, the UAE has solid regulatory frameworks. And it's not only that, they're constantly improving. So it's good to see, because in the UAE we aspire to have a financial hub and a financial ecosystem that's world-class, and we're on our way there.
We are there, aren't we, Rabia? Surely we are world class.
Totally, totally. And I mean, again, as an investment manager, we have a range of mutual funds that we promote in the market here through NBF and other partners. And being regulated in the UAE means that all of these funds, before we take them to the market, have to be submitted for approval by the regulator. So there's an application that goes in, the regulator approves it. And only after that point can the banks or other financial intermediaries make them available to the market. So they've gone through a vetting process to make sure this product is suitable. And then we spoke about professional versus retail investor. Who is this product suitable for? Because there are some products suitable for professional, others for retail. And that process, we go through it with the regulator to make sure that we're all aligned. Yeah.
I'm going to bring the conversation around to technology now, and I know, Bilal, we could have you sit here all morning and talk about this. So, where do we and how do we see, as an institution, where the role of AI and technology fits into this? Is it disruptive or is it an enabler? What are your thoughts?
Sure. If we predict how the world looks like in 10 years, I think everyone would fail these days.
Yeah.
Because the world's going to look very different in 10 years, right? You see the speed at which AI is evolving, and it's evolving at a very fast pace. And for our industry, it's actually very relevant, because if you think about our industry, we don't have a physical product. It's a professional service. And artificial intelligence by design is supposed to be more and more intelligent, which means it's giving better and better advice or recommendations. So it's not about where we are last year or where we are today, but you can already see where we are going in the future. We talk about the best qualifications in finance. You'd ask GPT-4 a question in finance and you'd be very surprised.
Yeah.
You could take a product that any financial institution gives you, a PDF, attach it, and ask it what it is, and it will tell you the answer. So it is very relevant. I think how it will affect the industry is, one, it gives us a way to get a validation or a second opinion. I think as an industry, we will definitely start integrating that into our processes. Another thing is if you look at costs for an organization to serve client bases is reliant on various different things, and what digital and technology does is it reduces cost and therefore makes wealth management much more accessible. To give an example of that, you think about client support. And you think about client support, when I used to call a call center, I used to have, and I still do, I would have to type 1, 2, 3, 4, 5. Soon we're going to have that in natural language with someone who appears human but is not. And if you look at what OpenAI just released a few days ago, you can see demos of that. It's already there. So client support is going to change. Wealth advisory is going to change. In terms of the tools that financial institutions use in the back end to deliver that processes, that's going to change. And there's a risk to that, but there's also a very good reality to that, which means it becomes more accessible. It becomes more reliable in terms of consistency.
What does that allow for the humans to be able to do then? Because surely that's freeing up the time for the likes of you.
So I think that's a tough one. I think it will be always hard to answer. But essentially, we're all getting services that used to be expensive from others for much cheaper. So it should allow us to offer new things. And that would be the normal response is, oh, jobs are created. But when it comes to your own individual experience, one of my pain points is when I call a financial institution, or I call Du or Etisalat, or I call anyone at the moment, I don't know who I'm going to get on the other line when it comes to client support. That's just one example of how AI can make professional services better as well. And I would hope that it doesn't take away all of our jobs, obviously, right? So I can't comment on that. But
we'll have AI
I'm
news
optimistic.
readers before we know it. I'm out of a job, don't worry. Haitham, I know that you have some input on this as well. I mean, what do you think we should be keeping our eyes on then in terms
I think, first of all, yeah, I think we're witnessing, a point in time where we really cannot keep up with the pace of how this technology is developing. Bilal mentioned we cannot imagine the world in 10 years. I would say even in the next 2 years. I cannot even imagine what AI is or how is it going to shape. It's really developing very, very fast. And what's really fascinating about it is AI is actually being used to develop AI further. So it can really accelerate much faster. Now, bringing it back to the industry and professional services, I see it more as a tool rather than a threat, and this is how we should look at technology in general. It really helps us in, for example, analyzing massive stacks of data, automating services. There's so many things that we will, in time, we will see how AI can fit within what we do on a daily basis. However, when it comes to professional services, when it comes to banking, when it comes to wealth management, there's a very important aspect of these relationships. It's the human relationships.
Yeah.
The client doesn't only come to the bank because there's a specific service, but because there's an actual person that they deal with. And that provides trust.
Yeah.
I would say something that the AI may not see at the moment is that every individual has different and unique situations. And this is where, for example, your relationship manager, your investment advisor would talk to you about and understand and then be able to guide you. The element of trust is because of that human interaction and human factor. So I think this is something that's very difficult for AI to take away, at least in the foreseeable future. And this is what will, where most of the efforts will be focused on nurturing these relationships and focusing on these human elements, while the back-end processes can be significantly automated. So yeah, it will help us all become more efficient and more optimal.
So Rabi, as well as the efficiency, trust is really up there, isn't it, in terms of key between?
Yeah, totally. And I don't want to repeat many things that I've said. Obviously, bringing down cost as an enabler and the ability to bring down cost across various points of an investor journey or servicing aspect is crucial. The pace, I think, is the scariest element of it, because even listening to a podcast with Sam Altman, the CEO of OpenAI and ChatGPT as a product, he was saying the hardest thing and the question he cannot answer is where AI will be in the next year or two, because of the pace of growth. So it's scary at a professional level, but also at a personal level, because younger generations are coming up in this era of AI where they'll be able to do everything and based on voice. So us as a generation, having been exposed to typing and autocorrect, now can't write well because we forgot how to spell because we got so used to autocorrect. So imagine future generations where they'll just talk to AI and ChatGPT, and it will type emails for them and essays and papers. So I think it's scary, but it's definitely making life and will make things more efficient going forward.
We're going to, a little bit, in a few minutes, open up to the floor for your questions, so you can get your thinking caps on in the meantime. Our time kind of jumped backwards a bit, so I'm trying to keep us on time in my head, but I would like, did you have something else to add on to that?
I did want to add just one thing.
Yeah, of course.
Because I think it is very relevant. There was an example, I forgot from who I heard, but it was about building trust. And it was saying if you have a jar And how you build trust is every time someone does something that makes your relationship more trustworthy, you put a marble. And therefore, it takes time to build a trustful relationship. And then one wrong thing happens, and you toss that jar onto the ground and it shatters. And what I'm trying to allude to is the fact that it takes time to trust. And I think what sometimes we don't realize about AI is it's going to get to a point where we don't trust it yet. But we're going to get to a point where we trust it a lot for professional advice in multiple different fields. And when we talk about personalization, I think what separates AI from traditional digital technology is the fact that it knows you more than anyone. Right? If you think about how much does Google know you, like Google knows me maybe more than 90% of my friends, right? So imagine with how much this platform will end up knowing you in your circumstances, your fears, your cares, your objectives, and now give it all the expertise possible. And the only thing now missing is trust. And the question is, how long will it take us to now start trusting it? And when we trust it, there is an element where it becomes very difficult to trust anyone else more than that, right? So I would just say that's something that keeps me up at night. So in terms of,
You've alluded to, I haven't even asked the question yet as to what keeps you up at night, but we've got that from you then, yes?
Yeah, I think that's one of the things that keeps me up at night for sure.
Amazing. Haytham, what keeps you awake at night?
I would say from an investment perspective, there's not much concerns, and the reason for that is if you're investing, like we said, going back to the earlier parts of the conversation, is if you're investing in a diversified manner, you have less concerns and less worried, and that's your goal with investing, is being able to sleep comfortably at night, knowing that your portfolio is going to fare well and is not going to cause you any concern. On the personal side, I think, yes, definitely the global topics of geopolitics, environment, and these things, they are a cause of concern, but I do have faith in the human ability to overcome the challenges that they face. So this is what actually, brings me back and keeps me, sleeping well at night.
Thank you. Rabia?
Well, besides literally my kids who keep me up at night, but I think the other thing is, which is a good thing, is the fact that as humans, we have a longer life expectancy, right? So we're going to live longer. But at the same time, that comes with challenges because you now need to invest better, to save better, so that you can fund your retirement, which as it stands, they haven't, in France, they threw, massive protests because they extended the retirement age by a year.
Sure.
But at this point, we sort of want governments to start reacting a bit more and increasing retirement age because we will live longer. And so if we're retiring at 60 or 65 and living to 90, 95, that's a long time to be living off of savings. And so, it's always something in my mind about making sure I'm investing for that period of my lifetime. Especially for us who, where we have kids and stuff, because there's, life's expensive.
That sort of brings us full circle to the first answer we had, so thank you very kindly for that. So do we have any questions from you, our audience, today? I think there should be some mics with the gentleman, if anyone. We have a table over here, if we can get a microphone. Thank you.
Hello. So my question was, if you had to invest in indices, which are the indices you look at? And I know you mentioned about missing out on few days and how it impacts. Will just dollar discounting help in that case? Because the market is volatile, and the best thing to do is maybe put money in indices. So which are the indices that you rate as 1, 2, 3 to maybe dollar cost discounting every month and invest?
And you're looking at me, so I'm going to answer that.
Because you're the one who mentioned that point. So.
Yeah, no worries. So look, dollar cost averaging is definitely the right strategy, right? I gave an example of just a lump sum amount, which also has its benefits if you stay invested. Look, in terms of indices, for me personally, S&P 500 is my best representation for international markets. And this isn't advice, I'm not giving advice here. It's just at a personal level, that is a good representation of global markets, right? Because if you go to indices and you go more world, you start to over-diversify and you start to cannibalize a bit of your returns, right? So it's very hard to get, passively speaking, to for all markets to be doing well at the same time across the world. So there's going to be times where the US is doing well and Europe isn't. There's going to be times where Japan is doing well and China isn't, and so on and so forth. So going for a world index has its risks in terms of cannibalizing returns. So if you just want to pick one index and invest over long term, S&P 500 would be my preference. Now, that's not to say it's the right strategy altogether, and I think that's where I go back to my bucket, approach, because active is what then enables you to access the best of each market at different market cycles, right? So market cycles, where you want to be, first of all, geographically, where do you want to be from an asset class perspective, equity versus fixed income, but then going deeper within equity to say, I want to be in value versus growth at this time. Now that market's turned, I want to be in growth. And that's where active managers take those decisions on your behalf, because they're very difficult to make as individuals, right, who aren't looking at this day in and day out. So, Haytham, you wanted to jump in?
Yeah, just continuing, yeah, definitely you want to have, I would say definitely several indices and have several geographic exposures. Now, going back to Rabia's point, definitely there will always be times where certain markets will perform better. This is just how the markets behave, and this is just how the financial market and the economy operates. So what you can do is, have an overweight, for example, to a specific market in a certain period of time, and then maybe when things change, have some kind of a rotation, but still maintain the diversification. One thing that I would really, and I think you mentioned this in your question, is dollar cost averaging. I think this is one of the best tools and the easiest methods for individuals, especially ones that are, living off a regular income or a salary, to invest. If you invest on a monthly basis, and for example, and Rabia's earlier example, the S&P 500, he mentioned that if you started with $10,000, you would end up in 35 years north of $400,000. Now imagine if after starting with that 10,000, every month you added $100 or $200 or $300. The amount that would be at the end is in the millions. So this is one of the easiest tools. And you don't even have to look at the market. You don't even have to do much research. Just be consistent. Invest monthly. This is something that I personally do, and I've been doing it for a very long time, and I would say this is one of the best tools and methods for individuals to invest over the long run and get access to these. And it doesn't take much time, I would say. It doesn't take much time out of you to do much research. You don't have to follow the news. Is the market going to go up? Is the market going to go down? You don't have to worry much about that. You just simply be consistent. And I think that's the challenge here, is just being consistent and investing monthly for a very long period of time. But at the end, and we've seen it time and time again, there's a lot of statistics, there's a lot of studies that prove this is a very, very effective method of investing.
Say, like, when we think about investing in indices, what are we looking to do, right? So what is the whole concept of investing in an index is to diversify exposure. So if we think about what we're really owning, is we're trying to own the global production as much goods and services as possible. So if we think about how this couch got here, which company was related to the raw materials, the manufacturing, they had to make telephone calls, who was the phone provider. So like the way that everything is set up here today is because companies are for profit and allow that to happen. So essentially when I'm investing in indices, I'm trying to say I want to get as much exposure to the production of goods and services. And S&P 500, what is S&P 500? You could say somewhere around 60% of global public equity markets is represented in the S&P 500. And if you look at the S&P 500 as well, you'll have these companies are not US companies, they are US companies, but 40% of their revenue is from foreign countries. So if you think about someone like, I alluded to Google earlier. So Google, yeah, a lot of their revenues exist from the UAE as well. So you have international exposure. But what I would also want to allude to when you are investing in an index-based approach and you want to diversify your sector ownings, you think about how important semiconductors are and semiconductor manufacturing. The biggest two companies in semiconductor manufacturing today are TSMC in Taiwan and Samsung in Korea. So essentially, by having a more diversified approach, sometimes you get access to sectors that are not well represented even to the S&P 500. We look at consumer discretionary, so fashion items. Most of the fashion items are actually in Europe. So having a global approach can benefit you of having access to sectors or to companies that are important in the world, but not necessarily represented.
Listen, ladies and gentlemen, please can you put your hands together and give a big round of applause for our fantastic panel this morning, and thank you as well.